Markets are mixed with just about 30 minutes left until the closing bell on Wall Street. And for bonds, we're seeing the 10-year hover near 4%. We saw some big swings earlier in the session on the heels of that softer than expected reading on wholesale inflation earlier this morning. Joining us now is Andrzej Skiba. He is the RBC Global Asset Management Head of U.S. Fixed Income. And thank you for joining us today. We've seen Let's just begin with the 10-year. We saw that top out at about 5% late last year. We had this incredible rally in bonds that led the yield to dip below 4%. We saw this everything rally in stocks on the back of that. Where are we with regard to that trend right now?
Well, thanks for having me. Yes, you have a lot of investors who have been astonished at the pace of the rally in the last 8 weeks of the year and trying to make sense of what next steps to take. In our opinion, we have moved a long way, so some consolidation is warranted, and that is exactly what we're experiencing over the recent sessions when it comes to US Treasuries, but also credit markets broadly.
Well, and we just got some big bank earnings today, and I bring that up because the big money center banks are going to be offering or selling about $25 billion worth of debt this month alone. We got a lot of other supply coming online. What are the opportunities for investors here in both investment grade and high yield?
Well, when you look at the high-grade universe, it's pretty clear that financials, so bank debt, has lagged non-financials significantly over the recent quarters. So we are looking at a spread differential, a yield differential between those two segments close to historic wides. So with the exception of the turmoil that we have experienced in the spring of 23 with the regional bank crisis, financials have not been this cheap compared to non-financials in fixed income markets. And we know for sure that there are a lot of fixed income investors awaiting the issuance of significant amount of supply in the coming sessions. As banks report earnings, that could be an opportunity for those investors who missed a bit of the party in the back end of last year to add to exposure to this segment of fixed income universe that looks particularly attractive.
And more broadly, Andrzej, as we start this new year in 2024, what are the returns you think bond investors can generally expect?
We are quite constructive in terms of the outlook for total returns in US fixed income. Whether you're looking at high grade or high yield, we see a strong likelihood of high single digit to maybe even double digit returns within the asset class. All you need to see is some marginal spread compression, a little bit of a rate rally over the coming 12 months. And investors taking advantage of the substantial carry, of the substantial yield that is on offer. So after a strong year of returns in 2023, we do believe this could well be repeated in 2024, helping to erase some of the painful memories fixed income investors experienced in 2022.
Yes, we witnessed that firsthand here as we were covering that. I want to ask you about the Fed here. The Fed itself, FOMC members who are filling out their forms for the SEP, they believe they're going to be, well, you don't necessarily want to call it projection, but they're looking for 3 rate cuts next year. That's what they wrote down on their cards, but the market is pricing in 6 rate cuts. And the disconnect I think I'm having and a lot of investors are having is that when you get to 6 rate cuts, that's almost getting into recession territory, needing to get from behind that 8 ball. Where do you see the Fed landing this year?
I think you're spot on. In our opinion, market has got a little bit ahead of itself in terms of pricing 150 basis points of cuts between now and the end of the year. We do think rate cuts are coming. We do think they will be substantial, however, less than is currently priced by the market, and also starting perhaps a bit later than initially priced in. Like right now, market is pricing over 70% probability of a March rate cut. We think investors might have to wait a little bit longer, but those rate cuts are coming, in our opinion.
All right, we're going to have to leave it there, but really appreciate your insights there. Thank you for that, Andrzej.
Thank you very much.